everyone, my name is Marissa. I'm a correspondent with the Business Times, and I was seeing discussion on structural reform in Asian capital markets. We're really lucky to have a very strong panel of speakers here today from across the investment industry. I'm going to jump right in and introduce you to our four speakers. First, we have Holden. Stephen is the CEO and founder of Copley Fund Research, a firm that monitors equity fund positioning and fund flows in emerging markets and Asia ex-Japan to provide analysis on market trends. Next, we have Dr. Soraphol Tulayasathien. Dr. Soraphol is the Senior Executive Vice President of the Stock Exchange of Thailand, and Dr. Soraphol oversees corporate strategy, international relations, and research for the Societe. We also have Eric Jungers. Eric is the head of equity prime brokerage in Asia at Societe Generale. We also have one more panelist who will be dialing in soon. This is Omar Slim. Yeah, so hi Omar. So last but not least, we have Omar Slim. Omar is the Senior Portfolio Manager for Fixed Income at PineBridge Investments. I'll open with some talking points, and members of our audience can also send in questions via the Q&A button at the bottom of your screen. We'll try to address all of your questions over the next half an hour. Let's get started. Stephen, earlier this year, you wrote about how China positioning among active equity managers has reached peak underweight going into 2020. Can you talk about what you're seeing in your data now and how this has changed over time?
Yeah, absolutely. So China's still the biggest underweight, and I'm talking about emerging market active investors here. So China's still the biggest underweight by quite some margin. And it's also the largest underweight it's ever been in the last 11 years or so. So versus the index, China's underweight just over 5% now. But at the same time, allocations towards China on an absolute level are at their peak. So EM investors are allocating just under 35% towards equities at the moment. So the interesting part about the China underweight and its evolution is that we've always been underweight China. EM funds have always used China as the underweight leg for overweights in other countries and sectors. But it used to be that EM investors are underweight the Chinese financials, typically the state-run financial stocks, together with a bunch of other state-run companies in EM like Gazprom and some of the Brazilian state-run enterprises. That was a very popular trade. But what's happened now, due to the nature of the index changes, as EM managers are running big underweights in the kind of new technology stocks, such as Alibaba and Tencent. And that dynamic's very different due to the kind of massive performance of Alibaba and Tencent, but also due to the size of those two stocks in the index. So you've got big risks for active managers running big underweights in Alibaba and Tencent. And now we have the addition of China A shares with a multitude of stocks that active managers haven't invested in yet. And so you can actually boil down that 5% underweight into Alibaba, Tencent, and China A shares, which now represent decent sized risks for active investors, especially in light of the performance or the outperformance of the pandemic. So that's where we sit at the moment, I guess, among active managers.
Okay, thanks for that interesting perspective. My next question is for Omar. Omar, how developed are credit markets in Asia compared to the rest of the world? And what interesting changes do you see happening now? And what changes do you expect to see in the next few years?
Yeah, that's a good question. I think the key point to know about the credit markets in Asia is that really the markets are quite varied in terms of how developed they are and how deep they are. So for instance, the USD market is quite a bit more developed than the local currency market. And within the local currency markets, you have varied depth in terms of market, trading patterns, liquidity, and so on. I think we can talk about that during the webinar, but I think one key point is that the development is really not the same for all of the credit markets, and it varies quite a bit, particularly between the USD market, the USD denominated market, and some of the local currency markets like the CNY, the IDR, the MYR, and so on and so forth.
Okay. Okay, thank you, Omar. Dr. Soraphol, could you talk about some recent steps that the SET has taken to attract more companies to list on the exchange and to attract more international investors?
Well, I think the best way to do it is to make sure that the market is the most liquid. At the moment, SET is the most liquid in ASEAN. We have about daily average trading. Another one is that we want to facilitate the companies that are interested in coming to listed. And the way we do that is we now employ many of the digital process, like digital IPO or digital visibility, so that make the company able to tell their stories to the investors, as well as we're now realigning our process, having more like the IM relationship manager, so that our employee can target the potential listed company more effectively. So these are the things we want to make sure the infrastructure is there, or the digital is there, make it easy for the companies to come in, as well as try to give them a personal touch, so that they can use us as their platform.
Thank you, Dr. Soraphol. Eric, you and SocGen interact a lot with the buy side. Which markets in Asia do you see more interest in right now?
Thank you very much, Marissa, for this question. I think I will focus a bit more on the equity side compared to Omar or what Stephen mentioned. On our side, we interact mainly with two kinds of investors. On one side, we have more long-term or fundamental investors like the pension funds or the foreigns and assimilates. And on the other side, we have much more, I would say, opportunistic or deal-focused type of players like the hedge funds. Maybe it's linked to our firm, but we've seen much more always interest towards emerging markets compared to developed markets, and more or less pro rata the market cap of each country. Nevertheless, recently things have changed a bit, and we see much more interest skewed towards China, India, or to some extent Thailand. I think China is because a lot of things are happening. You have the fundamental, you have the macro, you have the geopolitical games. It's still a market where you see some opportunities to arbitrage or to take some real relative value trades and so on. A bit the same of India, which for me is the one that is increasing its presence and importance for investors more and more. Maybe once again, it's linked to our own offer in SocGen, because we are very active and I would say somewhat advanced in some market making of some futures and so on. So we provide a lot of liquidity to investors. So maybe that's why they come more to us. And finally, we see a lot of interest in all the corporate actions. Would it be IPOs? Would it be different mergers and so on that are happening? And obviously, they are much more common in developing markets, again, like India, or a bit, we've seen some on Singapore or Thailand recently. And this is where we see a lot of interest. So I would say a lot of interest in emerging markets, even with what's happening in COVID, and skewed, at least for us, toward China, India, and to some extent Thailand.
Okay, that's interesting. So you're basically seeing a lot more interest in emerging markets Asia right now. But Stephen also mentioned that there's this historic underweight towards China. So actually, it looks like investors are interested in deepening their access in investing more in the Asian capital markets. But what do you think are some of the common challenges faced by investors who are trying to increase their exposure? And what opportunities do you think there are across Asia to deepen capital markets? This question is for all of the panelists.
I think from our perspective on the credit side, and again, going back to the earlier point, I said that the credit markets here are quite different. And I think for the purpose of this webinar, I think you're focusing more on the local currency markets. And I think those markets are quite different in terms of accessibility. So for instance, if you take some of the much larger markets I often talked about, which is obviously the CNY, the renminbi market, the Chinese market, which is a huge market really when it comes to fixed income markets. I'll let Eric cover the equity side of it. But when it comes to the fixed income market, that's north of $12 trillion worth in terms of the size of the market. That market traditionally has been very insulated, very dominated by the Chinese investors, particularly when it comes to the non-sovereign bond. So you've got quite a few of the Chinese government bonds, and then you've got the quasi-sovereigns, and then you've got the corporate. most of the internationals tend to focus on the quasi-sovereign and the Chinese government bonds. And I think the Chinese policymakers have been gradually, very slowly sometimes, but very surely opening up that market over the past few years. Other markets that are also quite large, like the INR market, for instance, tend to be dominated by onshore. Other markets, if you take, for instance, the IDR market, the Indonesia rupiah, there tend to be a high foreign ownership, particularly of the Indonesian government bonds, less so for the corporate sector, which is less developed. At the other end of the spectrum, in terms of accessibility, you've got a market such as the Singapore dollar market, which is quite open. Still, most of the interest comes from onshore, from Singapore investors, but it is a market that is quite accessible operationally and from a tax requirements and tax considerations, for instance. So I think to answer your question, one is accessibility from an operational perspective. Two, some of the tax considerations that are always a bit of an issue, particularly for some markets, KRW, for instance, and other markets. Three, and quite frankly, this is something that people don't talk about a lot, but some of those markets don't really want to open up that much, or don't really need to open up that much. For instance, the Malaysia market, Thai market, and I know that we have Thai representation on the panel today, the onshore bid is extremely strong. So there isn't, some of the policymakers don't feel that they need to open up that quickly, at least not all of the segments of the market. So it really depends on how the regulators and the policymakers are thinking about it. And of course, from a global investor perspective, so firms such as ourselves, we also need to see if this is an interest, both from a currency perspective and from a yield perspective and from a market movement perspective. And that's not always the case, given that some of the onshore markets tend to be quite expensive.
Okay. Would anyone like to give the view from the equity market side?
For Stock Exchange of Thailand, the way we plan to deepen the Asian market are two ways. The first is that, as I think everyone knows, the theme on the ESG is quite a big trend in the next couple of years. In Thailand, there are a lot of companies that are in Dow Jones Stock Sustainability Index, and we have 20 companies. That's the most. And we try to promote more and more companies to be in this theme. So we want to ensure that our product is of interest for international market on the ESG side. So what we need to do and what we are doing is to make sure we encourage the companies, we educate the investor in our countries, we make sure the availability of data in English so that the international can tap. So that's the first thing. The second thing, as one of the speakers mentioned, a lot of the emerging market is not open. But Thailand, we are a bit more open, and we want to be, can be helped as a connector. A couple of years ago, we are able to do the DR, security receipt of a Vietnamese ETF and list on Thai Stock Exchange. So it's now possible to invest in Vietnamese ETF to the Thai Stock Exchange. And the good thing is that this not only benefit Thai investor or international investor who wish to use Thailand as investment in Vietnam, but also increase the liquidity in the Vietnamese ETF also by 30%. So this is a win-win-win for both Vietnamese, Thailand, and the investor, both domestic and international. So I think to make the Asian market more deepen, we want to focus on ESG and be a gateway for international market in this region.
Okay. Eric, could you give a perspective on what, you know, when you speak to the buy side, what are the challenges?
Yes, sure. So I will talk. Sorry, Marissa, thank you. So I will talk from a provider point of view. So I will try to compare the offer of different exchanges.
Yeah.
And what I will say is a bit like what Omar said about capital markets and Forex, but for equity. So for me, the big difference between a developed market and an emerging market is the depth of the offer, or at least the standardization. Any developed market, which is Japan or Europe or US, you have more or less the same offer in terms of products, in terms of regulation is quite similar. Emerging market, what is different is it's not the case. So you have discrepancies. It does not mean that some markets are not very developed. If I take the derivative markets, India is the biggest single stock derivatives listed market in the world. Korea has been one of the most active listed derivative market in the world. So it's not just about they cannot do things, it's not uniformized. Where we see especially big discrepancies is on the stock loan or repo market. A lot of markets don't offer that, especially to foreigners. And that doesn't allow people to express their views and then to bring liquidity. It's also damaging at some point for the countries, because MSCI, who is providing the biggest indices to replicate for the long investors, they take these kind of things into consideration in the universe they can consider and the stocks they can consider. So not having those feathers will reduce the capabilities of those markets to be included and having a big share in MSCI and other large indices.
Okay, so I guess the biggest, Okay, so the biggest limiting factor then would basically be the regulators, right? Is that what you're saying? Okay. So Stephen, could you talk a little bit more, because you talked about China just now, but what about broadly for the rest of Asia? How has equity positioning changed over time, and what are some of the patterns that you're seeing over this year?
Yeah, sure. So in line with China increasing, I guess Asia's portion within emerging market funds has increased quite dramatically. We're on an all-time high allocation within EM funds. So Asia takes up around 71% of all allocations, but again, it's a reasonable underweight, that China component. The interesting thing in Asia is we've already mentioned China peaking and taking this dominant role within Asia to a massive extent. Outside of that, everything else is fairly, it's not particularly positive. If we look at Taiwan and Korea are very safe. They tend to be slightly more favored by value investors within emerging market. India is looking vulnerable, especially the financials. We're seeing selling coming in from a fairly decent overweight stance. Indonesian financials are looking vulnerable for the same reason. So very well held big positions in some of the Indonesian financial stocks that are starting to see some reversal. And especially during the COVID pandemic, some of those kind of risk areas have been sold off. And then outside of that, you've got Thailand, Indonesia, Malaysia, Philippines, which are really on their lows. I mean, they're dwindling, if you like, as part of an emerging market portfolio. So in those areas, it doesn't look particularly positive. And again, everything appears to be geared towards China at the moment. It's getting bigger in indices. It has the biggest, broadest universe to invest in, and that's where investors appear to be parking their money. In terms of specific regions, we've mentioned India and Indonesian financials look vulnerable. On the opposing side of that, China healthcare, we're seeing some big spikes in allocations across Asia ex China and emerging market funds. So it's a real area of focus. And not just because of the pandemic that was happening pre-2020, where emerging market investors, China investors, are increasing allocation. There's 2 or 3 key stocks within that WuXi Biologics is one of them that's starting to see bigger and bigger interest from kind of the big institutional money abroad. So China healthcare looks interesting, and some of the energy stocks as well. Energy's very much beaten up across EM, and we're approaching the kind of all-time lows of allocations here. In selected areas, Reliance Industries is interesting to us. It's seeing buying as the market's coming off, as well as Lukoil. The rest of it looks still pretty tired, but there are selected opportunities in the energy space, which I think managers will be looking at, given how depressed the sector is at the moment.
Okay. Any other perspectives on how to get Asia on par with developed markets?
I mean, if you look at global funds, Asia is still a small portion, and China particularly. And what you tend to see is the bigger companies getting the investment, and the rest been largely ignored. So you see some of the Chinese banks, AIA Group, for example. HDFC Bank in India is a big name for global investors. But in general, it's still small. And even if you look at global investors, the US is taking a larger and larger portion of that pie as well. So EM, and particularly China, is really kind of non-existent at the moment. A shares are still massively underrepresented in global portfolios, and in some extent to EM portfolios as well. So that's going to drive growth as global investors become more comfortable owning a selection of those companies. I think there's still a lack of knowledge out there. There's hundreds of companies that people haven't really done the due diligence on, or don't make initial screens, so don't get invested in. That will change, I've no doubt, and Chinese weights will increase in global portfolios. I'm less convinced about the other nations and the current trends. There's very little interest outside of China and India, Taiwan and South Korea among international investors to kind of invest in these kind of lower Asian regions. And I guess finally, Vietnam's always worth mentioning, and this goes along to the kind of access issue as well. It's not in the indices yet. It probably will be at some point, but again, it's not a particularly wide universe to invest in. But more and more EM investors are investing in Vietnam. It's an outside of benchmark bet, if you like, and I think that's going to receive more attention as we look to shift supply chains from China and kind of reduce that single country risk on supply chain. So that's an interesting area to focus on as well, I think, and we'll probably see growth within the broader EM theme.
Okay. So I guess one of the themes I'm hearing is that more research is really important into helping investors better understand certain emerging market countries. Omar, could you talk a little bit about, generally Asian corporate bonds offer attractive premiums to developed market credits. There's also this, historical concerns over transparency and governance issues. Do you think this perception is changing, and how do you yourself, deal with these challenges when investing?
Yeah. Again, I would differentiate between two types of markets when it comes to credit. So there is the US dollar denominated bonds issued by Asian domiciled issuers. So that would be corporates, sovereigns, quasi-sovereigns. And that market is reasonably homogeneous in terms of some of the reporting requirements and so on. That's at about $1 trillion market. And then you've got the other markets. Again, we talk here about the larger ones, for instance, being the renminbi market, Korean won, and to a lesser extent, Thai baht, ringgit, Singapore dollar, Hong Kong dollar, and so on and so forth. When it comes to, as a general statement, the governance in Asia tends to be generally weaker than some of the other markets, particularly the US market, for instance. So if you compare two markets that are more comparable, for instance, the US dollar denominated Asian credit market with the US dollar denominated US market, then yes, as you pointed out, that there is a bit of pickup, and that pickup is really related to two things. One, the US market is deeper, even though the USD Asian market is reasonably deep as well. And some concerns about the transparency that you alluded to. To narrow it down a little bit more so that we can be specific, those transparency concerns tend to be more focused in terms of the sub-investment grade issuers, so the lower credit quality issuers. And we all have heard of certain stories where some CEOs disappears or CFOs disappear, or they discover some accounting irregularity and so on and so forth. To be fair, that trend has been improving. And I think corporates understand that to get access to the market, even though, to be honest, some investors tend to have a short memory when it comes to those things, and they tend to be quite forgiving. They understand that for them to be frequent issuers and recurrent issuers, they need to improve their investor relations outreach. And we're seeing that happening, and those issuers tend to be rewarded. On the local currency side, that tends to be more confusing and quite it's really on a country by country basis and on an industry per industry basis. There are quite a bit of local currency issuers that are not very transparent. Some of them have caused some issues in some of the local currency markets, including to a certain extent, for instance, Singapore market, but also other markets. And I don't think there's a secret recipe for that to disappear, except to have a more a more stringent kind of requirement from investors in terms of transparency. I think some regulators have been more proactive. For instance, the Monetary Authority of Singapore has been more proactive in terms of trying to increase that transparency. But broadly within the Asian local currency market, it tends to be very different, and even the ratings are not the same. The way that rating agency rate is not the same. So it tends to be very specific to the country, to the market, and to the issuer. And to answer your last question is, how do you mitigate that? I think you can mitigate that only by having on-the-ground research, trying to talk with the issuers as much as feasible, trying to understand their business model. I don't think these are kind of investments, particularly when it comes to the local currency market, where you can do just by reading a research report. You really have to have a strong touch point with the issuer.
Okay. Dr. Soraphol, so you mentioned that the SCT is the most liquid stock market in ASEAN. So what important reforms, in your opinion, did SCT undertake to, sort of achieve this status? What were the key things that SCT did to achieve this status?
I think we employ many. It's not one measure, but we do a lot of things. For example, on the mix of the investors, we have quite a large proportion of retail investors. At the moment, close to 45% of the daily trading is from retail. And what we notice is that they tend to employ trading via online. So we try to facilitate them to give information, as well as try to make it easier for them to open their account on board electronically. This is one thing. We also noticed a lot of the young people, the Gen Y, coming in, even though they don't trade so much, but in numbers, they are quite large. In terms of the institutional investors, we see a larger and larger proportion of the domestic institutional. This is more or less on the government policy to allocate some of the big funds, like the social securities or government pension fund, toward more of equity, both foreign and abroad. So this is a trend. For the foreign, there's a lot of recent increase in foreign flows, largely also on the high frequency trading. I think this is a trend globally, but for Thailand, it's only recent years. So with this mix of investors, as well as a mix of products, Thai product is quite diversified. Our industries are not dominated by any single industry. It's many of the health, tourism, electronics. They are all quite. They have their fair share of weighted. Also in services industry that is coming. So both demand and supply has helped with the liquidity. I like to get back to one of the Omar's comment on the corporate governance. I think it's very important, and for Thailand case, we have placed a lot of emphasis on CG, the corporate governance, since our crisis in 1997. After that, we employ the methodology from IOD. We developed institutional directors to help improve the corporate governance of companies. So we have done that since 1997, and that has helped a lot. And now we are uplifting, because it's not only governance that seems to matter now, but environment and social, and also governance. So we now try to make it into ESG. And this is, of course, to make sure that it is in line with the international standards. And it's so that investors from foreign as well as domestic can believe in us and invest.
Okay. So Just now, Eric mentioned that some of the popular markets are China, India, Thailand. So Stephen, could you talk about, for funds that are looking closely like at these markets, how has their performance been and what kinds of strategies are deployed mostly in these markets?
So, I mean, we look at emerging market funds and Asia, Japan and China funds. So within those markets, it really kind of, emerging is the largest asset pool that we look at. And so performance from active managers this year has been challenging in light of the volatility we've seen in the market. But the biggest theme that we look at the moment is this differential between growth markets and value markets. And so growth funds or emerging market funds that are geared towards aggressive growth stocks, high growth stocks, versus those that are looking at a value stock universe within the same emerging market universe. There's an enormous divergence in performance. It's kind of the highest it's ever really been. And if we analyze the portfolios of emerging market value investors versus emerging market growth investors, there's some really big and key differences within those portfolios. And so the kind of divergence between value and growth is at its highest level ever. And so we're going to get some really different outcomes in performance between this growth and value set. And they're basically positioned for entirely different outcomes. And you see that reflected across country investments and sector investments, where value is maybe less geared towards the kind of China story. And that's the biggest kind of underweight, if you like, in value versus growth, but more traditional industries of kind of, kind of Russia and Brazil and things like that. So that's how kind of the investors are split in my world. And that goes for global and US investors as well. So this kind of growth value split is something that people are watching fairly heavily, I think, at the moment.
Okay, that's very interesting. I have a question from the audience for Dr. Soraphol. For a question for the SET, how would you maintain investor confidence through a crisis?
I think the first thing for the exchange is that we give confidence that no matter what happens, we will remain open, and we will make sure that we have a stable system to ensure that investor can come in and buy and sell and readjust their positions. And we also employ some of the measures to make sure that the market is not irrationally too volatile. This is not only Thailand, but you can see that in March, a lot of the exchange have employed some of the more measures on short selling as well as ceiling and floor. We don't ban short selling, but we just adjust the uptick. So just a little bit, just to ensure that not too much volatility, so that the market come back. And this is only temporary measures, just only this instant. And another thing that we do is we want to give out information as much as possible. As you know, during COVID, a lot of companies cannot come to the office. So we launched a way that company can distribute their information via the video conference. So that investor will be sure that market is open. Investor will be sure that the market is not too crazy, too volatile, and they have information that they can judge by themselves what are the situations. So these are the three things. That's externally, but for internally, just to add that we make sure that our employee is safe and sound and free of COVID. So at the moment, about 80% of the employee at the SET, Stock Exchange Thailand, we work from home. I am working from home. That's the background. You don't see my house. We make sure that everyone report their health conditions, and we make sure that even now on Sunday, as the Thai economy is now start to open, shopping mall is now opening. We make sure that our employee stay safe and they report their health condition regularly. This is to make sure that the market will functions.
Okay. Thank you, Dr. Soraphol. So we have 1 more minute to go. Would anyone like to, any closing remarks, any thoughts on the topics that we discussed, how to deepen access to capital markets? Okay, if not, oh yes, Eric, yeah, go ahead.
No, I wanted to say that despite what we all said today, I see a big trend in the last years in Asia of opening, getting more up to speed and something like that. And I think it will continue. So I'm very optimistic about the future of Asian markets, whatever the asset class is.
Okay. Anyone else? Right, so thank you, gentlemen, for speaking with me today, and thank you, Smartkarma, for organizing this webinar. I'll hand over the mic back to Amanda from Smartkarma. Thank you.
Thank you.
Thank you.
Thank you.